Welcome back, everyone, to the Risk Intel podcast, powered by SRA, where we share risk intelligence from experts across the banking industry. I'm your host, Ed Vincent, Executive Vice President at SRA. Welcome to the Risk Intel podcast. I'm Ed Vincent. With me today is CEO and co-founder of Strategic Risk Associates, Michael Glotz. Michael.
Hey, it's great to be here, Ed. I can't wait to talk to you about risk.
Today's topic is engaging risk committees. So that could be an executive level risk committee or a board level risk committee. Michael, let's start before we get into techniques and best practices and lessons learned from your experience interacting with board committees. Let's take half a step back and talk about the distinction between an executive risk committee and a board level risk committee and when one might exist versus the other.
Yeah, and an executive level risk committee is usually started kind of earlier in a bank's history, as they're smaller and growing. And it's made up of the executive management team, generally the CEO, the CFO, chief operating officer, if you have a chief risk officer. And as banks get larger, they find that they'll need to have a board level risk committee. Usually as banks grow over $1 billion in assets, the board committee is formed so that they can specialize a bit and focus on more and more risk as they grow. And generally you see both executive and board risk committees almost 80% of the time or more in banks above 10 billion in assets. So banks above 10 billion have those two working together. It's generally a similar agenda, but smaller banks tend to have an executive risk committee that report out to the full board of directors, or maybe even reporting out to the audit committee of the board.
Okay. And what's the objective or agenda for that committee? What are they tasked with?
Number one is setting the risk appetite of the bank. How much risk is the bank willing to take in credit, interest rate risk, and liquidity? So that risk appetite is really important. But, broadly, I would say that risk committee should ensure that the right risk framework is in place for the size and complexity of the bank. Do they have the right risk personnel, the right risk systems, the right risk processes in place? And so that's a responsibility of the board to make sure that it's in place, make sure the management team has put the right governance in place, for instance. And then lastly, it's really incumbent upon that committee to understand what are the top risks of the organization. I would say, one of the best practices is a top 10 risk report. What are the biggest risks that may impact earnings and capital? And what is the management team doing to mitigate those risks? So you have the framework, you have the risk appetite, which is the risk that the bank will kind of operate in. You have the top risk. And then I would say, lastly, it's really what losses has the bank incurred in the last quarter or two. So, everything is about risk is projecting the future. But what happened last quarter, last few quarters in terms of loss events? What were the unexpected losses? And why didn't the bank anticipate those losses? So collectively, Ed, that would be a really full agenda.
And that risk committee, then, and maybe this is where we introduce the chief risk officer into the mix, because, right, if you've got 4 deliverables there of setting the risk appetite for the bank, ensuring that there's a risk framework in place, understanding the top risks of the organization, and then looking backwards at what losses have been incurred. What's the role of the chief risk officer interacting with that committee, whether it is in an executive risk committee or board level risk committee?
Yeah, that risk officer really takes a lead role in making sure the risk framework is in place. Are the right risk positions in the right areas, and that's not only within the risk team, but are the right risk positions in the IT area or information systems area, or the right systems there. So making sure that risk framework is in place really falls on the role of the chief risk officer, and that's people, process, and technology. And as part of process, I would say governance on top of that. Is it governed correctly? Do they have the right technology, the right people? A lot of people assume the chief risk officer's main role is to manage risk. I would say while there's an element of that, the chief risk officer is ensuring that each one of the executives in the bank is managing risk appropriately. And that chief risk officer has oversight to make sure the risk is being managed appropriately. And in some cases, the chief risk officer might be assigned to manage some of that risk, but it's really the executive team and the CEO that has that day-to-day responsibility for managing risk.
So it sounds like you're crossing over there a little bit into some of the best practices, if you will, of the chief risk officer and that risk committee. And one of those best practices is not necessarily taking individual accountability for risk, but ensuring that there is a framework in place and that it is being managed, and that there is a culture of risk across the organization.
That's exactly the word. Culture of risk is great, because at the end of the day, the chief risk officer wants to ensure that there is a good culture in risk management. It's really the board's obligation to make sure that that culture exists. Practically speaking, the CEO sets the tone at the top, from a cultural perspective.
Any other best practices when it comes to equipping that risk committee to being successful? What can that chief risk officer do to make sure that committee is equipped to, whether it's field questions from the rest of the board, be equipped if a regulator comes knocking on the door? Any other best practices or lessons learned from that chief risk officer having interacted with that risk committee?
Some of the other key best practices is, one, if the chief risk officer can ensure that, the issues across the bank are managed effectively, and that might mean aggregating those into one set of comprehensive reporting for the bank. What we see in a lot of problem banks is individuals managing risk in their own departments, which is always good. But the board and management team needs a holistic view of what risks are being managed, what risk improvement activities are out there, how they're tracking, and the board should have some level of oversight to, that issue tracking and issue management. The other thing I would say is a best practice is really monitoring risk more than once a year. It's, risk assessments are fine on an annual basis, but more continuous monitoring of risk, as we've seen lately, you have to move at the speed of risk to measure risk. And that's not once a year. That's continuously monitoring the risk using key risk indicators, aggregating that data, and making sure management has more real-time risk information.
Great. So to recap that, then a few key objectives there for the risk committees: setting the risk appetite for the bank, ensuring that there's a risk framework in place, understanding the top risks of the organization, and looking back and understanding what losses the bank has incurred. In terms of approaches for that chief risk officer interacting with the committee, ensuring there's a risk framework in place, people, process, technology, ensuring that risk is being managed across the organization, and that there really is a culture of risk. And then, finally, the best practices you mentioned there around comprehensive reporting, getting a holistic view of risk across the organization, including tracking risk improvement activities across the organization. And finally, the concept of continuously monitoring risk. So quite a bit to digest there, but some great best practices for those chief risk officers who are forming or looking to strengthen their interaction with risk committees within the bank. Michael, thanks for the perspective today.
Thank you, Ed.